Morning, people. Joe Neighbour, Signal Centre. And today I'm going to run through my trade setups with you, or a particular trade setup with you. Just going to run through the entire process of what I go through in order to come up with a trade idea. I'm going to show you how I find out or decide what markets to trade. I'm going to talk about the timeframes that I use to analyze. I'm going to talk about the timeframes that I use for execution. Going to talk about planning the trade and what I'm looking for overall from a risk reward perspective, and where I'm looking to get in and where I'm looking to get out. Going to talk to you about the specific execution of the trade as well. So really going through quite a lot of one of the strategies that I use to trade. There are two strategies normally that I use, one of which I may go into detail on at another time. It generally follows the same process, but the execution is slightly different. So I may come on to that at a later date. And then I'm going to talk about potentially adding to winning trades if I get myself in that position, and how I would look to go about that. And finally discuss some tips on how I manage those trades once they are live. So I've just gone through the introduction there. As I say, what markets to trade, timeframes, etc. If you watched yesterday's webinar on conflicting trades, then you'll kind of get a bit of an idea about my initial process. But I've cleaned off my charts, and I'm just going to run through this all with you now, so you can see how I go about my my business. So let's just stop sharing this and flip it over to a chart. So yesterday, what I went through, for those that didn't see it, was analyzing baskets of currencies. So one of the key things that I do on a weekly basis, and it's a key part of my process, is analyzing individual currencies. So Aussie dollars, sterling. On the right hand side, you can see on my watch list, there is a list there of baskets that I've created. So I've got a US dollar basket, I've got a euro basket, a sterling basket, Swiss basket, Aussie dollar basket, Canadian dollar basket, New Zealand dollar basket, and a Japanese yen basket. Now, what I've done here is created a basket of all the currencies combined together to give me a feel about how the underlying or the base currency is performing on its own versus the rest of these currencies. So from that, I can then analyze these markets and then formulate whether or not I'm bullish or bearish, and then decide which markets that I'm going to trade. So I'll go through each of these markets on a weekly basis and map out how I want to trade. So I've highlighted Aussie for you at the minute, and how you create these baskets. You have to type in the symbols AUD, USD, and then you have to times another currency. So you're effectively bundling them all together. Again, any questions about this, get in touch and I'll be happy to share those codes with you. But let's just crack on with a bit of analysis. So I go through each of these markets and I tag them whether or not I'm bullish or bearish. And at the minute, I'm bullish of US dollars, and anything that's tagged red, I'm bearish of. So let's start with looking at Australian dollar and how I've got to the conclusion that I'm bearish on this. So this is a weekly chart in the top left here. And what I'll do is just simply conduct some basic trend analysis to decide whether or not I'm bullish or bearish. So start off with some, what I can see immediately, which looks to be a pretty significant downtrend, which we have there. You can obviously muck about with these lines, depends on where, how you would normally do that. But for me, it looks like there's a breakout of a channel. Doesn't look to be any sign of any bottom patterns forming here. Yes, there's some long wick candles, potentially sign of a reversal, but overall on a weekly basis, I can determine that that trend is lower, and therefore my bias, just by looking at this weekly chart, should be that I'm looking to sell into strength on anything with regards to Australian dollars. So let's look at the daily chart, just to zoom in a little bit nearer to the closer price action. And what I would now be looking to do is use Fibonacci wherever I can. So I will determine that this is the most recent swing high, or most key high that I would target. And this is from the 1st of January. So I'll take the Fibonacci for a grid from there, draw it to the bottom. And there we have that. So then I'm looking for a minimum of 38.2 as a level to potentially target. And I think anything up to these levels, 50, 61.8, 78.6, I would be looking to potentially short, because while we're below this 78.6 at least, and even below this high up here, I still think the bias needs to remain bearish. So I'm looking for opportunities to sell. I can confirm here that from this recent rally, we are approaching a 38.2% Fibonacci retracement level. So there could be some potential selling action around here in the near term. Drilling down further into the 4-hour chart, as you can see, we've seen this big bounce back. We've got some resistance forming potentially here. We've been unable to break to new highs to form a higher high on a closing basis. At least we did have a little poke through, formed what looks to be a hammer candle on the 4-hour, sorry, a shooting star candle on the 4-hour chart. We've gone up to try and make a new high, come all the way back down to close at the lows, and then the price has continued to move lower. So for me, at the minute, looking at this chart, Aussie is a bearish case, and I want to be looking to short Aussie currencies. Now, I've done the same for all the other currencies, and I've determined that US dollars are bullish. I've obviously gone through and run the analysis in a similar sort of way. Now, what I would do is go through individual markets and start pairing these up. So I'm bearish Aussie, I'm bullish US dollars, so therefore I'll be looking to sell Australian dollar versus the US dollar. I'll be looking to sell sterling versus US dollars, etc., etc., until I've formed a number of markets that I want to focus my attention on for the week ahead. Now, all these markets have already been tagged. So anything red, I'm looking to be a seller of. Anything blue, I'm looking to be a buyer of. And then it's a case of just repeating the process again. So I'm looking to drill down on all these markets and find opportunities to trade them. So this is Australian dollar. This is Australian dollar versus the US dollar. And this is the market that I've highlighted for particular attention today to run through with you all. This, again, is the weekly chart in the top left. So we can start conducting some analysis here and highlighting overall trends, trying to target some key levels of resistance and support. Clearly, we've got a downtrend there, certainly in my eyes anyway. Yes, we've had a big shoot to the downside and a sharp recovery higher, but in my eyes, I think we're going to see a continuation of the downtrend, and I'm looking to sell rallies. Looking at the daily chart, again, I'll use my Fibonacci where I can. That high from the 31st of December down to those lows, and as we can see, we've seen a reasonable retracement. We've overshot the 38.2% retracement. We've come just shy of the 50% retracement, but we have started to see some stalling in price action around here. So for me, I would be highlighting this as a potential short. And where do I think the targets could be on this? Where do I think this could ultimately go? Well, if you just base it on where we're at today, I would be expecting this sort of flip here to maybe call the recent, call the top. So we could see a swing move lower. And I'd be looking for a move back to these key lows that we've seen here. We've tagged this down at 55.03 on the 19th of March, and I see no reason, based on the fact that we've got a very bearish long-term trend, that we couldn't see a trip back to that level in the short to medium term. So that would be my ultimate target in the sort of short term. From a risk reward perspective, looking at it purely on a daily chart, then we have around about 3.4 as a risk reward ratio, placing a stop above that recent swing high. So I've established that I want to be short of Australian dollar versus the US dollar. I've established using weekly charts and daily charts that we have a firm trend in place. And I've also established where I think the price could ultimately go. And I've used a daily chart to establish that rather than any intraday chart. So that is my ultimate target of where I think price could go. So this is one of the strategies that I will use to trade on an intraday basis. This is the 4-hour chart that I'm looking at here. And I'll again use these Fibonacci levels where I can. So we've got a nice spike to highs there on the 9th of March. So I'll use that as the most recent swing high down to that swing low. And then I'm looking for Fibonacci levels 38s, 50s, 61.8 and 78.6 as levels to potentially do business, or where I think that the price could potentially be capped in the short term. The target remains the same on a short term on this chart. So I'm looking for a move back down to these lows that we saw on the 19th of March. So that is where I'll be targeting on any short trade that I look to execute. Now, I try to keep it very simple, and I'm looking for a specific trigger to trigger any trade. And I use, again, the 4-hour charts for this, and I use just a simple 10-period exponential moving average. This is my trigger. What I'm looking for is a solid close below that 10-period moving average, having already established where the trend is, looking for it to have failed at a particular resistance level. Doesn't necessarily have to be Fibonacci levels. It can be just normal supports and resistance levels, horizontal support and resistance levels that I've determined I feel where price could potentially reverse. So here we have a reversal or retracement from those recent lows. We've overshot the 50% level and we're moving towards the 61.8% level. And I'm just going to remove that for now because it's just a little bit in the way. So we've seen a move up here. I'm looking for opportunities to sell, as we've established. We've got just shy of this 61.8, and we've run into this cluster of previous price action over here. And now what we've seen here is a reversal candle. We've pushed up to new highs and we've moved all the way back down to the lows and closed at the lows. And the next candle, we've seen a close below the 10-period moving average. So for me, that sort of sparks me into action. Now I'm thinking, okay, there's potential to get short here. So I've played around with variations of this over the years. Selling on the close of the candle is a viable strategy. If you were to do that, you would just place your sell level on the close of the 4-hour bar. You would keep your stop loss as tight as you possibly can, so above that recent high that we've seen. Yes, it may run into the 61.8 and that may actually act as resistance, but I want to keep my stop losses as tight as I possibly can and the risk reward as good as possible as well. Ultimately, I'm looking to target a move down to these lows as we've established on the daily chart. So by taking that trade on the close of the 4-hour bar, I'm looking for around about 5R on that particular trade. So if that were to play out, obviously that would be very nice. Looking at it as it stands live in the market, you'd be on side 42 pips. And with 120 pip-ish stop, you're about 0.3R on side at the moment. So still plenty to go on that, potentially down to that target. But one method that I use in order to try and improve my risk reward even further, and it doesn't always work. Sometimes you will miss the trade by doing this, but I'm quite happy to take that chance because when the trades do present themselves, the risk reward is significantly better by attempting to trade in this particular way. What I've noticed over many years of adopting and optimizing this approach is that often when you get this break, let's just zoom in here to make that a bit easier to see. When you get these closes below the 10-period moving average, and one of the criteria as to whether or not this is actually a valid setup is when it closes below that 10-period moving average, the close has to be lower than the previous candle. Often you'll get long-legged wicks on your candles, and therefore it can make it a little bit messy. I'm looking for a significant punch through that moving average with a close close to the lows. Obviously not quite the case here. We did see a little bit of a recovery, but I'm happy enough that there is enough of a big body of selling that's taken place on that candle. So another way of getting a better risk reward on this, often I've noticed once you get these closes below the 10-period moving average, you will actually get a corrective move that will test the underside of the previous candle. And this happens quite a lot. You'd be surprised. So there, just at the low of this candle here, the candle previous to the break, you will often get a move back to that level before then the price continues to sell off. Now, what that means by doing that is I actually improve my risk reward that little bit further. So I'm putting my stop loss above those levels there that we mentioned on the previous setup, and I'm still targeting that move back down to those swing lows. If we can find it, there it is. So as you can see, where my risk reward was 5-1 previously, we're now talking about 8.6, which is another 3R or so, 3.5R better than what it was if I just closed or taken the trade on the close of the bar. So often you'll get these moves back to retest the underside of that previous candle, and that for me especially when you start to see that it actually fails as well. So we've seen a couple of attempts at trying to close back above that level and it hasn't happened. And then you've started to see the selling take place. So by having this approach, I'm now actually 1R on side rather than being 0.3R on side, as I would be if I'd taken the trade on the close of the 4-hour bar. So that is, in a nutshell, how I'm looking to trade. So I've gone through the process of highlighting what markets I want to trade. I've gone through the process of finding what the dominant trend is and what the trend is in the market that I've decided that I want to trade. And then I'm looking for specific levels to execute. Now, I do have another method for execution, and that is more looking for specific levels to set limits to try and trade. I'm not going to go through that today. But this is just one simple method, and I'm just using that 10-period moving average as my trigger to get into a trade. Now, when you're devising your own strategy, there's absolutely nothing wrong with using this. If this doesn't work for you, then you can pinch parts of it. Ultimately, any trading strategies that I've devised in the past have just been borrowing bits and pieces from other people and watching other people trade, and then formulating your own trading strategy and optimizing that over time. So if this resonates with you, by all means, feel free to use it. Maybe just take a look and see how these price actions or this price action works, and how often you get these pullbacks to test the previous candle. I mean, obviously, we've seen various examples where you've seen punches through the moving average down here, and yes, there's every chance I might have taken those trades. I mean, but the reasons I haven't is because, looking at it from a daily perspective, we've only just seen this move towards a key Fibonacci level. So I am looking for reasonable levels, and I'm not looking just to jump in on anything. I need to see evidence of resistance forming before I then start applying the execution rules to the trade. So now we're in the trade. Now we need to talk about how we're going to manage it. And potentially adding to it. Now, because I've got such a good risk reward on this trade, we're talking about 8.6 if it goes down to the ultimate target. Now, not all trades go to the target. That doesn't mean they shouldn't be winners. I'm quite happy to collect 4 or 5R along the way. If it's an 8R that I'm looking for overall, that's not a problem to me. Even if it's 1R or 2R, a win's a win at the end of the day. And not all trades will work out exactly as you think they will. So you have to try and remove that from your mind, and just try and capture profits where you can along the way, but obviously have a method for doing that. So how would I be managing this trade from now on? Well, I'd just be looking for it to take out, simple support levels. So we've got this candle here that posted on the 30th of March at 10 o'clock on the close at 10 o'clock. We've moved below there. If we close below there on so if we close below there on the 4-hour chart, then that for me would suggest that we could see further downside. I would then potentially be looking to move my stop from the highs up here somewhere around here. And the reason I've chosen that is because clearly this resistance level that we placed for our entry at 61.45 has done a reasonable job. So I just placed my stop loss above that level there. And all the time, obviously, we're bringing down the stop loss, and the risk reward overall is starting to increase rapidly as a result. So when I'm adding to new trades, that's something else that I would potentially do, because there's a lot of space between here and here to potentially see some variations of price action. So let's just assume that the price, muck about with this. So the price might start moving lower favorably, but it's not going to happen all in a straight line. It's very rare that you would see a price just go straight from here down to there, and if you do, they're obviously the best trades that you're ever going to get. But, realistically, it doesn't happen that way. So what may happen, and what I'm very prepared for to happen, is that we might see a period of chop. We may see brief consolidations on the way down there. So it may be that the price starts moving along and then we get another bit of consolidation along here, and then we can start drawing other Fibonacci levels on there. And if we start to see standard sort of standard stuff really in terms of retracements, if we see a 38.2% retracement up to there, and then I get another close below a moving average, let's say it triggered there, let's just draw another line. So let's say this is the price action in black. This is just say this is the moving average that's following it around. You know, price crosses below, above it, and then all of a sudden we're back here. So we've had a little bit of a retracement. We're still quite happy that the trend is going in the right direction. We might get a little bit of a consolidation here. Then all of a sudden we get a break again of this 10-period moving average, having just failed at a Fibonacci retracement level. So there's no reason why I can't take another trade there, because I'm still happy that the overall trend is bearish. I'm still happy with the setup. There's still a lot of distance down to the target. So then what I can do is take another trade on a close there. Again, applying the same sort of rules, looking for that pullback to the low of the previous candle. I can place a stop loss above the swing high, and I can target again a move down towards that support level. So now I've got two trades open. So I've got my first one at 8.5R, and I've got the second one at 7R. Now, there's no, in this instance, I'd move the whole stop loss down to that level. So my whole position would now be stopped at 60.40, let's just say. So rather than adding more risk to the trade, what I would simply do is maintain the same level of risk that I had at the outset. So I always risk 1% per trade. So I would still maintain 1% risk from here. So I would obviously be a few pips on side by the time I got to this level. I then could quite happily take another 1% risk level, but overall I'm probably still going to be in profit if it does actually go up to hit this level. So I'm never taking on huge amounts of risk. My leverage is never getting out of control. I'm just simply adding to winning positions and just trying to bulk them up. So when they get down to this level, if I'm still holding the entire position that I've taken here, added it here, and there's no reason why I might not see another sort of setup happen here. So if I get three positions, you know, got 3 times the size of what I initially taken on at the outset, and then we're down here at these sort of levels and it does go on to hit target, then obviously I've had a fantastic outcome. But if price action moves lower as I expect, and then we have a little bit of consolidation, then another break lower, and I take another trade. If this one fails and we see it push back up, I'll get stopped out. I'll lose my 1% on that second trade that I've taken, but I'm nicely on profit from the first trade that I've taken. So overall, I still expect to make a profit on that one. Now, obviously, as I said, all trades don't work out as you expect. It's just not the way it goes. And, you know, but when I do hit targets, or when these do play out as I expect, then I can be, you know, quite heavily involved in the position, and they can really pay off quite significantly when they do. So that's just one strategy that that I'll use, and obviously I'm moving the stop loss down along the way when I'm adding these new trades. If I'm not comfortable with adding another trade on, then I'll be looking for minor sort of retracements to place stop losses or lower my stop losses along the way to prevent giving back any gains. One thing you've got to be careful of is being aware of what your live risk reward is at any one particular time. And what I mean by that, if price action is down here, for instance, and you're still maintaining this original stop loss up here from the second trade, let's just look at how that looks. Let's move these out of the way. So this is where your stop loss is after you've added a second trade and the price action's down here. Well, let's just look at that from a live risk reward perspective. So that's where the current price is. This is what we're looking to target at 55.06, but our stop loss is up here still. So your risk reward as it stands on a live basis is 0.3R, which doesn't make any sense. You're risking 408 pips in order to make 123, or 124, which just doesn't make any sense whatsoever. So keep an eye on that and try and keep your risk reward on a live basis so it's no worse than 1-to-1 would be my advice. When you start to see these the price action move even further towards your price, then you may want to even consider using shorter time frames to try and manage your trade. Maybe move this down to an hourly or a 15-minute chart and just keep moving your stop losses down above previous or sort of minor swing highs. There's no reason why you should be giving up huge amounts of profits. You know, down here to give up a massive profit and it goes all the way back up there is criminal, really. And you've just got to try and keep hold of your profits where you can. Yes, it's going to be frustrating where you're going to get, you know, price action just quickly move up and snap back and close you out before it then actually goes to the target. But, you know, there's always another trade. Lock your profits in where you can and manage your trades as efficiently as you can, and just keep an eye on that live risk reward profile of your trades. Hopefully that was useful. As I say, it's just one of the strategies that I employ to trade. I may go through the other one at a later date. That's more sort of setting limits and snipering entry levels, if you like. Any questions about any of this, feel free to get in touch on Telegram, message in or comment on the YouTube video, or feel free to get in touch on Skype or email. The other guys will be back a bit later with some more content. And in the meantime, good luck with your trading, and we'll speak to you again very soon. All the best.